Hi everyone, my name's PK and here I've got with me John Manciameli, who I had on before on these episodes, but really grateful to have John again. We previously talked about how to improve or enhance your borrowing capacity, and so I'll leave a link to that right here. I'll put that into the video later. But in this episode, we're going to be going through something that a lot of you have asked about. It's about how to set up an SMS. What is the benefits of a self-managed super fund at SMSF, and how you can really avail the benefits of buying property through a SMSF. So if you don't have any equity left in your own home, or if you don't have any savings, but you've been contributing towards your super and you have a pool of funds in there and you want to get into this market or grow your portfolio, then we'll be going into the mechanics, how much you need, how much does it cost, how do you actually make it happen, the pros and cons. We'll be covering as much of that as possible in this episode, so hang around right to the end. So I think you guys all know me. I help people build passive income through property investing using data without using buyer's agent. And many of you might already know John, but if you don't, he's a veteran in the property investment space, huge portfolio himself, been an investor for multiple years. He's been a mortgage broker for multiple years. In fact, he mentors mortgage brokers. So he's almost like, one step ahead of the pack of the industry. And he's really, I don't want to use the word successful because it comes across with kind of different meanings, but he's really good at what he does. He's a titan in his space and he's super humble. So I'm very glad that you made time again, John.
Oh, thank you for that wonderful introduction, PK. Thank you so much. I might have to hire you as my PR agent.
I can be your scribe.
Thank you, mate. And I'm very humble with the response from the last video. So for everyone who's reached out to me, thank you so much. I'm really humbled. It's a privilege to help people on their journey, as you know, PK. Yeah. It's an absolute privilege. So yeah, it's been fun.
Awesome. And again, congratulations on the 3 properties that you just told me you bought. So, all the people I get onto this, onto these videos, onto the episodes, including me, they're actually in the game. They're not just, armchair philosophers commentating from the sidelines. They're in the thick of things. And, this is right from the coal face. So hope you guys get a ton of value from this episode. If you do, hit the subscribe button, turn the notification bell on, and most importantly, give it a thumbs up, and so it reaches more and more people. But without any more fluff, John, let's get into it. So let's just start from the start. It's kind of very basic for you, but a self-managed super fund, what is it and why should people consider it in the sort of real estate space?
Yeah, thank you, PK. Can I just first start that I can't give you any financial planning advice or any advice. This is a very, very complex area, and PK and we just can't give you advice. So anything we say or do, please go up and talk to your accountant and financial planner. I'm sorry I have to say that. But
no, that's good that you said it, and I echo what you just said. So none of this is personal or professional advice, but hopefully it adds a ton of value.
Yeah, this is really exciting because this is definitely another way to add to your portfolio. So what is a self-managed super fund, guys? So traditionally what happens is your employer will put 9% away into a retail or industry fund. And you may decide that with the help of your financial planner, that you want to take control of your super and create your own self-managed super fund. Okay. And so what this does is it allows you to have a lot more control and start diversifying your assets under management into a number of areas. All right. So when I talk to people who decide to set up a self-managed super fund, it's usually 2 to 3 key areas that they're doing it for. The first one is control, right? So it makes me laugh that you give money to someone and whether they perform or not, they get paid, right? I've never seen that. So, you can take control and go from there. The second part is the leverage. So if you've got $150,000 in super, you really can go off and control a $400,000 asset. And as you know, PK, it's all about cash on cash returns. So a 5% return on a $400,000 asset is always going to be a better return cash on cash than 10% return on 150,000 in shares. All right. So leverage is a wonderful concept there. And then the diversification. So if you like having a little bit of bricks and mortar in addition to your equities, or in addition to gold and things like that. All right. So that's 3. Another one could be the serious tax advantages. So during your accumulation phase, you're only paying 15% in tax rather than what would normally be a higher tax rate. Okay. And then during pension phase, there is no tax on the income that you're earning. All right. So your financial planner and accountant will tell you that it's the most tax efficient structure. All right. So please go and talk to them. So lots and lots of wonderful reasons to do it. But I hope that gives you a bit of a general overview.
Yeah, no, for sure. And I mean, that's why I did it as well. I mean, everyone's strategy is different, but I maxed out the equity or the serviceability that I could use outside of the super. And then when I'd maxed that out, I still had the property bug. I still wanted to buy more properties. So then I self-managed. I created an SMSF, and we went about it that way. We bought properties in there. So for me, I don't know if I had an abnormal or atypical experience, Sean, but it took me about, I think it was 3 or 4 weeks to set one up. My accountant did it. I think it cost about $2,000, and it costs around about $2,000 every year to manage. So we talked about some of the pros, but just kind of some of the hard realities. It costs money to set up. It costs money to maintain. Describe for me your experience of SMSFs. How much does it cost? Who do you need to be involved? How do you actually get it set up?
Yeah, good question, because there's a series of professionals that you'll need to engage to make it happen. So in the first instance, your accountant will set up the self-managed super fund and the trust deed. So now that varies from firm to firm. I've seen it as little as $2,000 and as much as $9,000. So definitely shop around and see, who's allowing you to set up the self-managed super fund. And I could be wrong here, but it's not that hard for an accountant to set it up because there's usually a template that they use to set it up. Mm-hmm. All right. Now, in addition to that, you need to have a legal representative to ratify the deed as well. Your accountant needs to register the self-managed super fund with the ATO. So there are some costs associated with that. Further to that, your financial planner, or if your accountant's your financial planner, but some financial planner needs to sit down with you and map out a strategy. So you might say, look, I want 80% in property and then 20% in shares. All right, but then you need to have a strategy.
Yeah.
Then there's other fees as well. When you buy a property, a bare trust has to be created. All right. So most people get this wrong. They think that because they set up the self-managed super fund deed, that's what actually has to go on title. That's wrong. All right. And the implications can be quite expensive. Now, just to roll back a little bit, the government doesn't allow you to borrow. The self-managed super fund can't borrow. So what the government did is created a provision where a bare trust gets set up that acts in lieu of the trust. All right. So what happens is when you're borrowing, it's the actual bare trust that borrows the money. And then once you've sold the property or the mortgage has somehow been extinguished, the title of the property goes back to the self-managed super fund. Mm-hmm. Right. So one of the big tips from this session today is make sure that you do not buy the property in a self-managed super fund, because once you get audited, you're going to have to pay stamp duty twice. All right. So really, really important that you make sure that happens. I actually stopped someone the other day. It slipped through the accountant, the solicitors and stuff. And I rang the client and said, hey, mate, you seem to have bought this property in your self-managed super fund and not the bare trust. Okay. So, so that bare trust, there's a cost associated with that, and there's a stamping associated with the bare trust as well. But in general, to set it up, $2,000 to $4,000, and then every year the self-managed super fund has to lodge a tax return, and it actually has to be audited as well. Yeah. So you'll need to figure in another $2,000 for that process. And bear in mind that if your self-managed super fund generates more than $75,000 per annum, you need to lodge a BAS. And let's hope we all get to 75 grand per annum.
Yeah, well, it's tax-free in the pension phase. So yeah, that's the idea. Um, and like my wife and I, we have a combined SMSF, and that's also what's possible. Whereas if you know, outsource your super to an industry fund or something, you have to have separate funds. But is it just that spouses can pool their funds together, or can broader family units? How does that pooling of funds work?
Yeah, good question. You can have up to 4 members in a fund.
Okay.
There could be, 4 members. It can just be 4 members, a maximum of 4 members, and they will act as, they can be the trustees of the fund, but normally there's a corporate trustee that looks after the self-managed super fund. But anywhere up to 4.
And they don't have to be family, or it can be anyone.
It can be anyone. But generally speaking, it's family.
Yeah. Makes sense. And if we kind of get down to the property level now for a second, John, you know, you can buy properties for as little as $250,000, $300,000. You don't need to buy $1 million, 500K properties, but there's different leverage ratio or different amount of deposit you need to buy in a SMSF or through a bear trust. What's your kind of guidance? You know, some people say you need 200K minimum to, you know, contemplate buying a property in an SMSF. Other people say 150. Another person said to me the other day that 120 should be okay as well. Some lenders are okay with 120. Well, what's your thoughts on that?
Yeah, there's a lot of confusion around this, and the reason is it varies from lender to lender. So generally speaking, at an absolute bare minimum, you need 20% deposit plus costs. So if you've got that $250,000 price point, you can see now that the amount of money you need in your super fund is a lot lower than if you've got a $400,000 price point. Now, to make it even more confusing, a lot of the banks have what's called a liquidity test. Okay, now the liquidity test is when the bank says they want to see 5 or 10% in cash of the property that you're buying. So for example, if you wanted a $400,000 property, some lenders will say we need to see $40,000 sitting in cash, just in case you don't have tenants or there's an emergency and things like that. All right. So it varies from lender to lender. There's been a swing back to not having as much liquidity anymore with the lenders. About 5 years ago, all the lenders started coming out with 10% liquidity, and lately it's been 5%. And there's now some products coming out with zero liquidity. All right. So in answer to your question, when it comes to finance, the cheapest rates will be with the biggest deposits. 40% deposit or 60% LVR will obviously get you the better rates. And then there is that difference between if you want to do interest only and principal and interest.
Yeah.
So the LVR, the deposit, the amortization, meaning P&I or interest only, plus a liquidity test, this all determines how much you need.
Right.
So this is where you need a broker who can tailor your circumstances to your particular strategy, because you can get a pre-approval where even if it doesn't service, that there are lenders that will say to you, if you get a letter from your accountant, if you're self-employed, saying that you're going to increase your minimum super from 9 to 10%, that might be enough to get you across the line. Or if you're a PAYG employee, you can get a letter from your employer saying that you just increase your super contributions from 9.5% to 15%. And they'll take that as future earnings.
Okay. That's really interesting. And so I might get the math wrong here, but just to play back what you've said, let's say you're buying a $300,000 property. You'll need at least, let's say, 20% deposit. So, you know, call it $60,000 or something like that, plus costs, you know, transaction costs, stamp duty, all that kind of thing. And then if there's a liquidity test, let's say 10%, that's another $30,000. So 60 plus 30 plus transaction costs, maybe that's up to 120. And then you may not be able to allocate your entire 100% of your super funds into real estate, you need to diversify and things like that. So am I wrong? I mean, this is not personal advice, but am I wrong in saying that if someone has even around, give or take, 150,000, it's still possible?
Yeah, that's exactly the number that I use. If you've got around 150, then you can start looking at it in all seriousness. And you made a good point about a concentration of asset class. The ATO, the government doesn't like you putting everything into real estate. All right. So it's really important that if you decide to do this, that, you leave some money in cash, or you leave 20 grand in equities or something like that.
Yeah.
But that's a really good way to put it. 150 grand is, generally speaking, the minimum before you can start looking at it. So what it is basically you and your partner, you might have two $75,000 industry funds. You put it into a dedicated bank account. That's called a PK, self-managed super fund bank account.
Yeah.
And then you're up and running.
Yeah, awesome. Guys, if you're getting value out of this, hit subscribe, turn the notification bell on. I think what you should really be contemplating about and thinking about is, if you're in your late 20s or early 30s, husband or wife or spouse, you probably have enough when you pull it together to make up 150, and you can probably, actually go out and buy an investment property through that. And of course, I can't give any sort of specific instructions here, but if you're leveraging, 80% of the bank's money, 20% of your own, even if that property is only growing by 5%, 6%, 7%, cash on cash, because of leverage, you're completely outperforming industry funds or other funds, because even though they're making, let's say, 7, 8, 9, 10% as well over the long term, that's not leveraged, or at least it's not entirely leveraged. Parts of it might be, but not entirely. So this is a way that if you have a bit of confidence in what you're doing, if you want education, or you really, know what you're doing, and you're happy to not sort of get your hands dirty, but just do things a little bit more specifically and intentionally, you can really set yourself up. And then in another 5 or 10 years, you might be able to get another few properties, and you can just see how by the time you retire, when you can access that income from your SMSF when you're 65 or 70 or whatever it will be by the time we retire, you have your retirement fund there. You don't have to rely on that $25,000 or $30,000 government pension. Right? It's a really important point, even if you're young. I used to think that, let me not think about my super, I'm never going to access it. Who knows if I'm going to even live to that age? But it's really important that you at least consider it. That's my sort of recommendation. And what are the types of properties, John, that you can actually buy in an SMSF? Is it that you can buy anything under the sun? Can you do anything under the sun? Or are you limited to just buying standard residential, only doing cosmetic renovations? What are like the boundaries?
Yeah, okay, that's a good point, because some self-managed super funds won't allow you to buy and build brand new properties all off the plan. And we are not recommending that anyway. But just be aware of that. A lot of self-managed super funds just won't get involved in it. So, just think of the typical type of established property that's been built. You can buy a unit if you want to, not that we're advocating it, but you can do that. So it's just got to be an established property. You can get warehouses and commercial. In fact, a lot of people who are tradies will buy that warehouse and put it in their self-managed super fund. All right. But for the purposes of the audience here, just think about everything that you speak about, PK. Your classic, non-flashy, good land component house that's already been built. That's absolutely perfect. All right. Now, when you get it, you can do some cosmetic renovations, but just get some really good advice on that, because if the government sees that you're starting to do construction and real structural work, that's a big no-no.
Yeah.
Right? You can't live in it. Okay. And people ask me that. And,
it goes without saying, but yeah, good to point out.
It is supposed to be for investment. If you buy a holiday house as an investment, I have heard people paying their super fund to live in it during that Christmas break or something like that. But it's got to be a third-party transaction. So it's got to go through a local real estate agent, where you pay that local real estate agent market rates. All right.
Yeah.
So that's the extent of pushing the envelope. But generally speaking, your classic investment where it's an already built property that may need a little bit of cosmetic work, but generally speaking, people don't even do that. That's just sort of maintenance. They just buy it and do the normal maintenance process. Okay.
Yeah.
And it just comes down to LVR, how much you want to put into it and how much concentration. I'm a big fan of property, so most of my self-managed super fund is in property. And a little bit of equities and a little bit of cash, but not that much. So
yeah, I'm a little bit too concentrated in property as well. A bit of a bias there. And like, I don't want to put words in like the regulators, mouth or anything like that, but there's probably some well thought out reason why they don't encourage, or in fact they don't allow in most cases, you to buy a brand new or off the plan apartment or house and land package or anything like that through SMSF. By nature, it's probably higher risk in their mind. And, those principles apply even if you're not buying in a SMSF. So, just kind of connect the dots, guys, see the forest from the trees, see how things start to kind of connect. And, oftentimes or most times, the best types of properties are, established, good land component, low maintenance, easy to get tenants in a growing area. That's just vanilla, stock standard, get rich slow property investing.
Yeah.
And
it's funny you should say that, PK, because every mistake that anyone can make, I've done it. Off the plan, brand new building, all that sort of stuff. It's just I got sucked into the property spookers, easy in hindsight. So listen to what everyone says, PK. Listen to what PK says, because it's tried and tested, and I have 20 years on PK, and I've done all those mistakes, and it's cost me hundreds and hundreds of those of dollars. So, yeah.
Well, no, listen to John, because here you can learn from his mistakes, right? Unfortunately, I didn't make those mistakes, or at least yet. But yeah, it's kind of a wise head on you. So it's good.
And that's why, PK, I think your course is cheap, because the mistakes that I made were hundreds of thousands of dollars. And I'm not trying to spruik your business, but I genuinely know that your course is going to save you the many hundreds of thousands of dollars in mistakes that I've made. And that's why I think your course is extremely good value for money. Yeah. Anyway, and self-managed super funds is a fantastic way to get on to add to your property portfolio. So if you're struggling to get to your fifth property like PK recommends, then maybe a self-managed super fund is something to look at. Get your advice from your accountant and your financial planner. Okay. And obviously a mortgage broker like myself who knows what they're doing. And it's interesting to note, PK, not all the big four banks have pulled out of self-managed super funds now.
Okay.
So really interesting. There's just so much regulatory compliance behind it that they just went, see you later. So I remember the days when AMP were, the number one self-managed super fund funder. They're out. Yeah. And then CBA's out, Westpac's out, St. George's out. So there are still some lenders out there that you may not have heard of. And the products do vary from lender to lender. So I'm just submitting a self-managed super fund for me, another one, going through a lender who offers an offset account. So I'm paying a little bit more in interest, but I'd like to park my rent in that offset account. And that's rare. It's very rare to get an offset account in a self-managed super fund nowadays. So
right.
Yeah, little tip there.
Yeah, I mean, I think it's a very popular thing for people to use the SMSF, the self-managed super fund, to buy property. I don't know about you, but I think it's becoming, even though the red tape is becoming larger and larger or more convoluted, I think buying property in SMSFs are becoming more and more popular. At least I can say for my clients, I think almost like 20% of clients are buying in SMSFs, which I never used to have. But I think the key question that probably everyone wants to know from you, given you're as experienced as anyone in the broking world, is mortgage or is serviceability or is lending tighter if you're buying through an SMSF? Is it looser? What do you need to know before you even think about all this stuff?
Yeah, so the lenders are looking firstly for the contributions to your super fund. So let's call it a retail fund. So you're working For someone, they just want to see the last 12 months worth of history of you putting money in there and also the balance. Okay, so that's number one. Then the second part becomes what sort of property you're buying, and they'll look at the future rental income of that investment property that you're getting. Okay, and then the kind of the last one is your liquidity test. All right, so is the bank asking you to leave 10% behind or 5%? In and amongst all of that, whilst they won't look at your income, your PAYG income, they will still need to see that because they need to know how much has been contributing into super. So say, for example, you're on $100,000 a year. I think current legislation says you need to put in 9.5%. So they just want to make sure that your income is matching your contributions into that retail super fund. Okay. Right. But in terms of serviceability, no, it's no different, no harder than a normal home loan. It is harder in the sense that there's just so much more compliance. There's just so much more documentation, and there's so many more people involved. All right. And you, as the trustee of your super fund, has some serious obligations. Right, you just can't set this up. The government will check to see if you've had a prior conviction. You can't be a bankrupt. Yeah. So there's lots of things that are involved that you could have gotten a home loan outside of a super fund. So if you're bankrupt, you can still get a home loan, believe it or not, but with higher interest rates and very, very low LVRs. But in a self-managed super fund, you can't. So the government really needs to make sure that the trustees of the super fund are worthy of managing the property and they're doing the right thing. And then you need to dedicate time annually. It's not a lot of time, as you know, PK, but you do need to create minutes of the meeting and have audits done and things like that. And so for the viewers who are used to having a trust, that's kind of where you're going to be heading. There's a bit more work because it's some sort of a trust. Yeah. But it's so worth it.
It's worth it, but
oh my gosh.
I don't know about you, John, but I've never created any minutes. My accountant always does the board meeting minutes and he kind of does everything. I don't know. Do you do it yourself or I don't know. Maybe I'm not doing it properly, but I literally sign some stuff and pay the 2,000.
Yeah, you're right, PK. My accountant does it too, but we're technically supposed to be,
there you go. There you go. All right. I've just broken the law. All right.
No. You have had minutes of the meeting. You've read through the minutes of the meeting and you said, yep, I agree with this. And occasionally you might change it. So
Gotcha. No, it's good advice. So it's not completely passive. Like I don't really spend much time on it. You probably have a more robust portfolio than me, John, in your SMSF, so you might spend more time on it. It doesn't come, completely without any time for anyone who's watching and listening.
It's not that bad. I'm making it worse than it really is, as you know. It's just more the setup. And once you get through all the jumping of the hoops to set up the deed and the bare trust, then it's just maintenance, really. You've got to audit it. You've got to get tax returns done.
Yeah.
And I'd factor in 2,000 to 3,000, you reckon, PK, a year?
I think I do 2,000, but that's because I give my accountant a whole bunch of other money for a whole bunch of other stuff. But if you don't have a complicated tax structure, then I think less than 3,000 max, unless you're doing very sophisticated things. But if you're just buying, you have a couple of properties in there or one property, 2,000, 3,000, something like that.
Yeah. It's just such a good asset holding structure because of the leverage, the amazing tax benefits you get. There's no tax payable when you're in pension phase. The fact that you can control it, and you can decide if you want to put it into crypto, if you want to put it into real estate, if you want to put it into some managed funds, you're in control, which to a lot of people is really important. But for me, the number one thing is just to leverage and into real estate, which is the best asset class. I think.
You and me both. Let other people can disagree, but we have a bias, I think. And so maybe just to kind of wrap up, John, what is, if someone's watching, listening to this, and they're like, I'm really inspired to set up a SMSF, what are like the first step, second step? Like, what do they literally need to do after turning this episode off if they want to start that process?
Yeah, usual port of call. Go see your accountant and financial planner. They will be able to assist you with setting them up and putting an investment strategy together. That'll be the first port of call. And then if you want to do leverage and finance in the self-managed super fund, then you contact your broker, who will be able to help you. Now, bear in mind, a lot of brokers don't want to do self-managed super funds. And the reason for this, it's purely commercial. When a broker earns typically 0.6%, and say they do a $200,000 home loan, that's only $1,200 for 6 months worth of work.
Yeah.
So when I say 6 months, it's, getting you right in all the compliance, and then, setting in the pre-approval, and then you're going backwards and forwards as you're finding properties and stuff like that. So a lot of brokers are like, I'm out of here. All right. So most brokers are now charging a fee because, it's just not worth their time, So just keep that in mind. Also, for those of you who are interested, I've got an insider's guide to self-managed super fund. So contact PK or myself, and I can send that through to you. It's a really easy step-by-step guide. What professionals you need, how to start, what your obligations will be as a trustee, and so forth. So I'm very proud. That book was written by one of my ex-staff who launched the self-managed super fund product at St. George.
Oh, wow. Oh, wow.
Yeah, so he was the one flying around Australia, teaching the solicitors and bankers and stuff about the St. George self-managed super fund home loan product. Yeah, so that intellectual property is still within the business, but
that's great. So suffice to say, it's pretty accurate. It's pretty useful. I'll get that off you, John, and if there's a website for everyone who's watching, I'll put that in the description below. But so there was literally dozens and dozens of people asking for your details from the first interview we did, and I think I forgot to ask your details. So I'm going to ask you now. If you want to share, John, what's the best way people can get in touch with you as a mortgage broker?
Thank you. Just send an email to john@hunterwood.com.au, JOHN@hunterwood, HUNTERWOOD.com.au, and just say you watch the podcast or you're a PK student, and so forth. And then what I do is I set up a 10 to 15 minute Zoom call to see if I can help. If I can't help, I normally say, hey, this is what you need to do, and I'll see you in a couple of months' time. But because I specialize in investment property, I really enjoy working with people and seeing their lives being transformed. I've got so many great stories, man. There's one that comes to mind, a 32-year-old who went down the path of buying investments, and he's debt-free. He lives in Shell Harbour in just south of Sydney, and he's able to have a family, and that was really important to him. And he says, John, at my age, I've got friends who are up to here in mortgages, and they can't even have a family because they've got the big mortgages.
Yeah.
So
no, it's very rewarding, to kind of help people, different types of people, different walks of life, even if it's not towards a big, hairy, audacious goal. Even just getting their first property, it's a big deal. So it's always, an honor to be a part of it. And anyone who's watching, right, like John is seriously good at what he does. I know that the clients that I've sent his way, all happy. So, there's so many mortgage brokers out there. Go with someone you can vibe with on the same frequency, but I can attest that John's a really good guy as well.
And PK, thank you on behalf of everyone who's watching. I keep saying this, I feel like that you really are making serious changes to people's lives. It's amazing. I've been doing this for 20 years. I've been on television, and I've yet to come across someone who makes data sexy, who explains it in a way that actually makes a difference. You read a lot of stuff, and all it does is confuse you. And at a superficial level, and what you're doing is drilling it down to a suburb level, and then the intra-suburb factors, and it's very clear. Makes it a lot easier. So kudos to you, mate.
No, thank you, John. I appreciate it. And if you got value out of this video, then leave. Let's do this. Leave an SMS self-managed super fund, SMSF below in the comments, SMSF, and then we can get that reciprocation from you. We'll do more videos, whether it's on SMSF or anything else that you want John back for. So if there's a topic you want, leave it in the comments below, but at least comment SMSF, and then I'll see that you guys actually got a lot of value out of this. I know that everyone wants to hear more and more and more from John. It's pretty rare that people with his credentials, his background, his level of seniority, actually just share their information on these kinds of forums. Normally they're on Sky News for like a 2-minute segment where it's just kind of, you can't go into the details. So this is very, like, it's a great privilege for all of us to be listening from him. So yeah, comment below, subscribe, and that way we'll get that reciprocation. We'll get John back. So thank you again, John. Anything else that you'd like to share before we wrap up?
No, I'm just really excited, mate. I'm just really excited about the next 2 years. At the time of recording, there's just incredible opportunities around the country. So don't despair. If you feel like you're missing out, don't worry, because there's so many opportunities out there. All right. So I know a lot of you are frustrated and a lot of you are scared and, I wish I bought here and that. It doesn't matter. I look forward to the next 10, 20 years. It's just an amazing time. Great country we're living in. If you, I think anyone you can call Australia home is just you won lotto, and then let alone the fact that you can get ahead in life with using property. So keep going, keep learning, and I look forward to the next session with you, PK.
Awesome. Aussie property is blue chip as you can get globally. So it's just so awesome. But thanks for watching, guys. I'm always grateful for you watching. Thank you, John, for making time. And we'll see you next time. See you later.